The moment you turn 70 and a half, the IRS quietly unlocks 7 provisions that can save you thousands of dollars every year in taxes. Not next year, not when RMDs kick in. Right now, at 70 and a half, and the vast majority of retirees will never use a single one of them, not because they do not qualify, because nobody explains that the rules change at this exact age. Most people think 70 and a half is meaningless. They know the ages that matter: 59 and a half when the early withdrawal penalty disappears, 62 when Social Security becomes available, 65 when Medicare starts, 73 or 75 when RMDs begin. Those ages get all the attention. 70 and a half gets ignored. And that oversight costs retirees real money every year they let it pass. Today I am walking you through all 7 provisions. Each one reduces your taxes, protects your Social Security from the taxable zone, or shields you from Medicare surcharges. Some take 15 minutes to set up. One can save you more than every other retirement tax strategy combined, and for some of them, the window closes permanently once RMDs begin. Quick disclaimer: I am not a lawyer, CPA, or financial advisor. Nothing here is legal, tax, or investment advice. These are educational examples based on current tax law. Always consult a qualified tax professional for your specific situation. My name is Nancy. If you are new here, this channel exists for retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement, with real numbers, in plain English. Subscribe now because next week's video covers what the IRS unlocks at 59 and a half, and that one could change your entire timeline. Drop a comment right now. Are you over 70 and a half? Just yes or no. Your answer determines whether my follow-up focuses on using these provisions now or preparing for them before you arrive. Let us get into it. Provision 1, the Qualified Charitable Distribution. This is the single most powerful tax tool available to any retiree over 70 and a half. And most people have either never heard of it or never understood how much it is genuinely worth. Starting at exactly 70 and a half, you can transfer money directly from your traditional IRA to a qualified 501c3 charity. This is called a Qualified Charitable Distribution, or QCD. The maximum in 2026 is $111,000 per person. If you are married and both over 70 and a half, each spouse can contribute $111,000 from their own IRA, $222,000 combined. Here is what makes the QCD extraordinary. The money travels directly from your IRA custodian to the charity. It never touches your bank account. It never appears as income on your tax return. It does not increase your adjusted gross income, your provisional income, or your IRMA exposure. As far as every IRS calculation is concerned, that money is completely invisible. And once RMDs begin, the QCD counts towards satisfying your required minimum distribution. So instead of withdrawing $15,000, paying tax on it, and writing a personal check to charity, you instruct your custodian to send it directly. The RMD is satisfied. The tax is zero. The charitable impact is identical. The IRS gets nothing. Compare the two approaches side by side. Without a QCD, you take a $15,000 RMD. It shows up as income, pushes your provisional income higher, makes up to 85% of your Social Security taxable. At 12%, the tax on the RMD itself is about $1,800. The Social Security cascade adds another $500 to $1,000. Total cost, $2,300 to $2,800. With a QCD, total tax cost, zero. Same donation, same charity, same amount, different route, thousands saved. If you give to charity in any amount and you are over 70 and a half and not routing it through a QCD, you are handing the IRS money you have no obligation to give them. Call your IRA custodian this week. Fidelity, Schwab, Vanguard, they all have a simple form. 15 minutes to set up. Real savings every year for the rest of your life. Let me show you the full impact with a real example. A married couple, both 72, give $10,000 per year to charity, $8,000 to their church, $2,000 to a food bank. Their income is $38,000 in Social Security, $25,000 in IRA withdrawals, and $3,000 in savings interest. Their provisional income, $25,000 plus $3,000 plus $19,000, half their Social Security, equals $47,000, above the $44,000 joint threshold. 85% of their Social Security is taxable. Approximately $21,840 added to taxable income. Now they reroute that $10,000 through QCDs instead of personal checks. They withdraw $15,000 from the IRA for living expenses. The other $10,000 goes directly to the charities as QCDs. Their AGI drops by $10,000. Provisional income falls from $47,000 to $37,000. They slide from the 85% zone into the 50% zone. The taxable portion of their Social Security drops from $21,840 to roughly $5,000. Federal tax drops by approximately $2,000. Same charities, same lifestyle, same dollar amounts, just a different route, saving $2,000 every year. Over 10 years, $20,000 saved on a $10,000 annual donation. 3 mistakes people make with QCDs. First, having the custodian send the money to them first, then writing the check. That does not qualify. The money must go directly to the charity without passing through your hands. Second, trying to fund a donor-advised fund. Those do not qualify. Third, executing the QCD one day before turning 70 and a half. The IRS is strict. You must be 70 and a half on the exact date of the distribution. Did you know about QCDs before today? Drop yes or no below. I am genuinely curious. Provision 2, the one-time QCD to a charitable remainder, trust or gift annuity. Secure 2.0 created a provision allowing a single lifetime QCD of up to $55,000 from your IRA to fund a charitable remainder trust or a charitable gift annuity. Here is why it matters. These vehicles pay you guaranteed income for life and send remaining assets to charity when you pass. Normally, funding one with IRA money means withdrawing it, paying income tax, and contributing the after-tax amount. With this provision, you fund it directly as a QCD. No income tax on the transfer. You get the lifetime income stream. The IRS gets nothing on the initial movement. At a 22% rate, the tax savings on a $55,000 transfer alone is $12,100. Including avoided Social Security and RMDs consequences, the total benefit can exceed $15,000 on this single transaction. Not right for everyone, but for retirees with large traditional IRAs who are charitably inclined, it is one of the most tax-efficient moves available. Provision 3, the pre-RMD IRA reduction window. QCDs start at 70 and a half. RMDs do not begin until 73 or 75. That gap, 2.5 to 4.5 years, is a window to deliberately reduce your IRA balance before the IRS starts forcing money out. Why does this matter? RMDs are calculated on your prior year-end IRA balance. Higher balance equals higher forced withdrawal, equals more Social Security taxed, and greater RMDs exposure. If you use QCDs during this window to reduce your balance by $50,000 to $100,000, your future RMDs shrink proportionally. On a $100,000 reduction, your first RMD drops by roughly $4,000 per year. That $4,000 reduction in forced income keeps provisional income lower, protects Social Security from higher taxation tiers, and may hold you below the IRMA threshold entirely. The math: a retiree turns 70 and a half in 2026 with a $500,000 IRA. RMDs start at 75. She does $15,000 QCDs annually for 4 years, reducing the balance by $60,000. Her first RMD drops from $23,170 to $20,632. That is $2,138 less in forced taxable income every year for the rest of her life. Direct tax savings plus the Social Security cascade effect, $700 to $900 per year. Over 20 years, $14,000 to $18,000 saved, all from charitable gifts she was going to make regardless. Provision 4, the last clean Roth conversion window. At 70 and a half, you have 2.5 to 4.5 years before RMDs begin, depending on your birth year. This is the final stretch of the gap years, and every remaining year of conversion capacity is precious. Once RMDs start, your required distribution fills the lower tax brackets first. Conversions then stack on top, frequently hitting the 22% bracket or higher. At 70 and a half with managed income, you may still have $30,000 to $50,000 of space in the 12% bracket. At 73 or 75, with an RMD eating $15,000 to $25,000 of that same space, your favorable conversion room shrinks dramatically and keeps shrinking every year after that. Every dollar you convert at 12% now saves you 10 to 18 percentage points on that dollar when it would otherwise exit as a forced RMD at 22% to 30% effective rate, including the Social Security cascade. On a $50,000 annual conversion, that represents $5,000 to $9,000 in lifetime tax savings per year of conversion completed. One additional consideration: every Roth conversion counts toward MAGI. At 70 and a half, if your MAGI stays below $106,000 as a single filer, you can convert up to that threshold without triggering IRMA surcharges. But remember the 2-year look-back. A conversion in 2026 affects your Medicare premiums in 2028. Plan conversion amounts with one eye on the bracket and the other on the IRMA tier. Provision 5. The new code Y on your 1099-R. Starting with the 2025 tax year, the IRS introduced Code Y for Box 7 of Form 10999-R. This code specifically identifies a distribution as a qualified charitable distribution. Before this existed, QCDs appeared on your 1099-R as ordinary distributions. Tax software treated them as taxable income. You had to manually exclude them, and if that step was missed, you overpaid. This happened constantly. Code Y eliminates that problem. When your custodian issues a 1099-R with Code Y in Box 7, your software automatically excludes the amount from income. No manual adjustment, no room for a costly error. If you completed a QCD in 2025 or earlier, and your preparer included it as taxable income, you may have overpaid. Check your 1099-R. If Code Y is there but the amount was still reported as income, file an amended return within 3 years. The IRS owes you that money back. Provision 6. Social Security, maximum benefit, plus provisional income management. If you delayed Social Security until 70, your benefit sits at its permanent maximum, 132% of your full retirement age amount, locked in for life with annual cost of living adjustments on top. At 70 and a half, the conversation shifts completely. Not when should I claim, but how do I protect what I am receiving from being overtaxed? The answer is provisional income management. Your provisional income equals your AGI plus any tax-exempt interest plus half your Social Security. For single filers, exceeding $34,000 makes up to 85% of Social Security taxable. For joint filers, the threshold is $44,000. With a maximum benefit of roughly $40,000 per year, half, $20,000, automatically enters your provisional income before you touch another account. As a single filer, you have only $14,000 of breathing room before crossing the threshold. Every additional dollar of income carries significant consequences. A $10,000 IRA withdrawal pushes you to $34,000, into the 85% zone. A $10,000 QCD instead keeps you at $24,000, well below the threshold. The IRA withdrawal would have made $20,000 of your Social Security taxable at 12%, costing roughly $2,400. The QCD costs nothing. The QCD unlocks at exactly the age when provisional income management becomes most critical. The two provisions are designed to work together. The IRS will never explain that connection to you. Provision 7. The senior bonus deduction stacked with QCDs and Roth income. The One Big Beautiful Bill signed in 2025 created a $6,000 deduction for taxpayers 65 and older, $12,000 for married couples where both spouses are 65 or older. The income phase-out starts at $75,000 single and $150,000 joint. At 70 and a half, you qualify automatically. But the real power is not the deduction alone. It is the deduction stacked with QCDs and Roth withdrawals. Here is the full stack in action. You need $50,000 to live on. Social Security covers $30,000. You need $20,000 more. You pull $10,000 from a Roth IRA, tax-free, invisible to the IRS. You execute a $10,000 QCD from your traditional IRA to your church, invisible to the IRS. Your AGI is just your Social Security. Provisional income sits $15,000 below the $25,000 threshold. 0% of your Social Security is taxable. The senior bonus deduction reduces taxable income further. Your federal tax bill, essentially zero. Now compare that to the retiree who pulls the full $20,000 from a traditional IRA instead. Provisional income jumps to $35,000, crosses the $34,000 threshold. 85% of Social Security becomes taxable. Federal tax bill, $2,000 to $3,000. Same income, same lifestyle. One pays zero, the other pays $3,000. The difference is knowing three provisions exist and stacking them deliberately. The IRS will never suggest this combination. Your tax software will never model it. Most preparers will never bring it up unless you ask specifically. And if you live in one of the 8 states that still taxed Social Security in 2026, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, the stacking strategy protects you at the state level too. Every dollar kept out of the federal taxable zone is a dollar your state cannot reach either. One critical warning: the senior bonus deduction is temporary. It runs from 2025 through 2028 only. If you are 70 and a half in 2026, you have 3 years remaining to use it. For a married couple, that is $36,000 in total deductions, saving approximately $4,320 at the 12% rate. After 2028, it is gone. Use every year of it. Here is the complete picture at 70 and a half. The QCD lets you donate up to $111,000 per year from your IRA completely tax-free. The one-time QCD to a charitable trust or gift annuity moves up to $55,000 with zero income tax. The pre-RMD window lets you shrink your IRA balance before forced withdrawals begin compounding the damage. The final Roth conversion window gives you the last clean opportunity to move money at favorable rates. Code Y on your 1099-R ensures QCDs are reported correctly automatically. Provisional income management becomes your most important ongoing tax calculation, and the senior bonus deduction stacked with QCDs and Roth income can bring your effective federal tax rate to zero. 7 provisions, all available right now. The IRS will not explain a single one. Here's what to do this week. 3 steps. First, if you give to charity and you are over 70 and a half, call your IRA custodian and set up a QCD. 15 minutes. Route your next charitable gift through the IRA instead of a personal check. Second, calculate your provisional income, AGI plus tax-exempt interest plus half your Social Security. Where does it land relative to $25,000 and $34,000? If you are above $34,000, identify how much could be replaced with Roth withdrawals or QCDs. Third, check your 2025 Form 1099-R. If you did a QCD last year, look for Code Y in Box 7. If it is missing and that amount was reported as taxable income, file an amended return and get your money back. Drop a comment. Which of the 7 provisions surprised you most? Just the number 1 through 7. The most common answer becomes next week's full deep dive episode. Hit like if this helped. Subscribe if you have not already. New videos every single week. See you in the next one.